In this week's video, we'll review the latest charts to help us answer the question, did we just witness the mother of all breadth thrust signals? This is a formal definition of a breadth thrust indicator that's available on Metastock. The important points for this analysis. A breadth thrust indicator is a market momentum indicator. Traditionally, it's based on advancing issues and declining issues. A thrust indicates that a stock market has rapidly changed from an oversold condition to one of strength, but has not yet become overbought. Most bull markets begin with a breadth thrust. The last statement is in stark contrast to the concept of the beginning of a bear market. A traditional breadth thrust is based on the advanced decline line. We'll be looking at it from a little bit different angle, but still using a breadth indicator, the percent of stocks in the S&P 500 that are above their 200-day moving average. So for illustrative purposes, let's assume we have 500 stocks in the S&P 500. When this indicator is at 100, it would tell us that every single stock in the S&P 500 is above its 200-day moving average. Conversely, when this indicator has a reading of 0, it would say every single stock in the S&P 500 is below its 200-day moving average. And like sentiment or overbought or oversold indicators, the percent of stocks above a 200-day moving average works well at extremes. The reading in late 2018 was 10% of the stocks in the S&P 500 were trading above their 200-day moving average. If we fast forward to April 8th, 2019, this is a very rare move here. This is your breadth thrust here in a traditional sense. This analysis here allows us to extend it and get an idea of what it means from the present day. In 105 calendar days, we went from having 10% of the stocks in the S&P 500 above their 200-day moving average to having over 70% of the stocks in the S&P 500 above their 200-day moving average. Thus, similar to all the studies that we've presented in these videos in calendar year 2019, we are simply taking a set of facts from the present day and asking, has this happened in the past? If the answer is yes, what happened next in the stock market? So basically what we're looking for, cases where this number here fell to 10% or lower and then moved all the way back to 70%. Stockcharts.com only has data going back to 2004. And over that period, we can see there were two instances similar to the present day. If we draw a horizontal line going across, there's only two cases where we hit the line. Case number one, 2009. We're below this level here or at this level here, and then we make it all the way back to the present day level of 70%. Second case, 2011. Draw a horizontal line over, we hit this, we make it from these levels all the way back to the present day level, or over 70%. It didn't happen in the flash crash. It didn't happen in the very difficult 2015, early 2016 period, only in 2011 and 2009. Going back to the original chart, remember, we're graphing the percent of stocks above their 200-day moving average. This is not the S&P 500. This is the breadth indicator. This is the look of it in 2019. This is the look off of the low in 2009. We exceeded our present day level of 70.74 on July 1st, 2009, when the indicator closed at 71%, telling us that 71% of the stocks in the S&P 500 were above their 200-day moving average. This is the look of the indicator off of the low in August of 2011, And to compare apples to apples, we want to go from the low level all the way up to the level in the present day, or 70.74. On January 25th, 2012, we exceeded this level for the first time when the indicator closed at 73.4%. Thus, April 8th, 2019, or this point A, is similar to July 1st, 2009, or this point A, and April 8th, 2019 is similar to this point A on January 25th, 2012. And basically what we're witnessing here in all three cases is a radical and rapid shift in the net aggregate opinion of all market participants. The look of this chart here reflects every single fundamental and technical issue or question that you can think of on every single time frame that you can think of. It's the market's interpretation of all the inputs and all the fundamentals on all time frames that causes this rapid shift. So in each case, it's a different combination of fundamentals and technicals and valuations or anything that you can think of, but we're using the same equation in all three cases. There's not one fundamental issue that you can think of in 2019 that's not baked into this chart. There's not one fundamental issue that you could have thought of in 2009 that's not baked into this chart. And every single what about this question was baked into the cake in 2011. And notice here, we're not making any predictions or forecasting anything. We're looking at hard data in all three cases. And thus, it's logical to ask, if this point here is similar to the present day, what happened in the S&P 500? This is the S&P 500 down here. This is 2009. In the lower left-hand corner of your screen, this is July 1st, 2009 here. This is our point A. If we fast forward, really good things happen for a long period of time. The look of this chart here and this 130% gain, additional gain, that doesn't include the move off of the low. July 1st is right here. The look of this chart seems to align very well with the definition or description of a breadth thrust that said most bull markets begin with a breadth thrust. Here's the breadth thrust, and here's the bull market. 2011 case, here is the breadth thrust, here is the bull market. After point A, or January 25th, 2012, which is similar to early April 2019, the S&P 500 tacked on an additional 117% over the next several years. And that's in addition to, it does not include the big move off of the low that began in October of 2011. Back to the present day chart. All of these moves are rapid and relatively rare, going from 10% to 30% this quickly, 10% to 40% this quickly, 10% to 54% to 64%, and out to April 8th with a reading of 70.74%. And this early leg of it here was covered from a more traditional advanced decline line based perspective in this January 2019 short takes post. Since the concept of a thrust speaks to a rapid and somewhat violent shift in the net aggregate opinion of all market participants, we wondered how these figures in the present day compared to the other two cases. In the present day, it took 17 calendar days to move from 10% to 30%, 25 days to move from 10 to 40, 44 calendar days to go from 10 to 54, 58 days to move from 10 to 64, and 105 calendar days to reach 70.74. Is this faster, slower, or about the same relative to the other two historical cases? The answer is, in every single case, faster. To get these rankings, we're comparing these columns. For example, it took 58 calendar days to move from the low to this point here, or a reading of 64.6%. In this case, it took 97 calendar days to exceed the present day threshold here, and apples to apples would be 58 calendar days to 163 calendar days to exceed the same threshold in the 2011-2012 case. Similar situation here. If the concept of a thrust or a rapid reversal in sentiment is meaningful, we got back to 54%, almost twice as fast in the present day case as we did in these two cases. Here, at least 2 times faster than the 2009 case, and the 2018-2019 case was over 3 times faster to get above 40.6, 25 days relative to 77 calendar days. If we were kids and we were going to a go-kart track, this is the go-kart that we would want to be in, the 2018-2019 case. Digging a little bit deeper here, January 25th, 2012, similar to April 8th, 2019. July 1st, 2009, similar to April 8th, 2019. How did the stock market perform after hitting each one of these thresholds in the two historical cases? The answer is quite well. In the first 90 days or so, we had some normal givebacks and ebb and flow, but we have to keep in mind these are the two historical points that are most relevant to the present day, because in the present day, we've gotten all the way back to over 70%. Thus, from those two historical points, good things happened looking out 30, 60, 90, all the way out over the next 5 years, telling us to keep an open mind about the possibility of much better than expected outcomes in the days, weeks, months, and years ahead. And even if really good things happen, and that's to be determined, we know with 100% certainty there is going to be normal and gut-wrenching volatility between a point A and a point B that could be several years down the road. The same thing applies to the January 25th, 2012 case. Really good things happened from point A to point B, but there was 100% normal and to be expected volatility pretty much non-stop between point A and point B. How is this helpful? This is a set of facts that just happened in the present day. Based on the data that's available to us, these are the only 2 periods in history where something similar happened. It's not identical, it's similar. And if anything, in the present day, you can make the argument that the 2019 thrust is more impressive than the 2009 thrust and the 2011 thrust. And in those cases, really good things happen for a long period of time. And of course, you can make the somewhat tired argument that we have a small sample size here. Well, we didn't cherry pick. We found every single case, the data that we had available to us. And like many of the studies that we've covered in recent weeks and recent months, all of them based on factual things that we can measure in the present day and then we're simply looking at history and asking what happened next. Much larger sample size in the study that we covered last week, going all the way back to 1950, paints a very, very similar and encouraging picture from a probability perspective. And the basic premise in this week's video aligns with the information and facts that we covered on January 5th, facts that we covered on February 1st, with the much larger sample size breath thrust study that was published on January 21st of this year on our blog, Short Takes. The small sample size study in this week's video seems to align well with the factual Bollinger Band analysis that we presented earlier this year. Seems to be singing off the same hymnal relative to the analysis we presented on February 22nd. This week's study paints a similar picture relative to the March 15th analysis and the March 22nd analysis based on a rare signal seen in the NASDAQ. A logical question might be, what about the yield curve? That question was answered on March 29th. If we revisit our bull-bear roadmaps that we started covering in a January 11th video, there's really not anything on our chart as of Friday, April 12th that contradicts this week's analysis. And one of our key things to look for guideposts that we talked about in January was to have the S&P 500 clear and hold above the orange 200-day moving average, clear, consolidate above, clear the 200, consolidate above it, clear the 200 in a convincing manner, and eventually consolidate above it. Thus far, we've cleared the orange 200-day moving average. You can claim this is a successful retest, and then we went on to print a higher high, a higher low, and now another higher high. Like everything else, we'll continue to view these roadmaps day by day. If the look of the chart changes, then we'll reassess the probabilities. That may happen, but it hasn't happened yet. These charts were used in the Friday, March 22nd video, which was the day that the yield curve inverted. Despite the big sell-off on Friday, March 22nd and the weekly loss, we noted that this still looked like a relatively constructive chart pattern. And we had just seen the third consecutive NASDAQ weekly close above the MACD center line. If we fast forward to the present day, or Friday, April 12th, thus far, we're holding above these potential necklines here. If you know chart patterns, the back of the envelope forecast for an inverse head and shoulders pattern tells us to keep an open mind about better than expected outcomes. And barring unforeseen circumstances, in the last hour of trading, the NASDAQ will print its sixth consecutive weekly close above the MACD center line. If we double back to the yield curve analysis, 3 weeks ago we said there were only 2 cases of first sign yield curve inversion that posted positive returns looking out 2 weeks and 1 month. That was the 1989 case and the 1998 case. Anything in this table here that contradicts the probabilities outlined in this week's analysis? The answer is no. Since the yield curve inverted on March 22nd, 2019, as of Friday's session intraday, the S&P 500 over the past 3 weeks posted a gain of 3.72%, putting it right in here in our yield curve inversion S&P 500 performance table, looking out 12 months. Is there anything else that says it's within the realm of possibility? Possibility is quite a bit different than a forecast, that the S&P 500 produces much better than expected outcomes over the next 5 years. It's a value line geometric index, a monthly chart as of the close on April 11th, 2019. It's a good way to track the average stock. 1995 on the left side of your screen, the present day on the right side of your screen. Price came up to this area here and was rejected in 1998. The average stock peaked well before the major averages in the year 2000. We came back up and revisited basically the same level in 2007. Price was rejected. Made a third attempt between 2012 and 2015, and once again, price was rejected. You can make an argument that this is a bullish breakout, what now appears to be a successful retest, and then a recapture of this upward sloping 50-month moving average. Retests can take many forms. They can be neat and clean. You can come down to the blue lines and bounce. You can come back toward the blue lines and bounce above them, or sometimes you get what's known as a head fake retest, a false breakdown, and then immediately move back to a successful breakout look. Not that much different than this look here with the 50-month moving average, a false breakdown. Not that much different than this look here, a false breakdown below an upward sloping 50-month moving average. Similar look here. Sometimes you can get really big moves after false breakdowns. And we all know the longer a market goes sideways, the bigger the move that you can expect to get when you either get a bullish breakout or bearish breakdown. This chart here in this week's analysis and everything that we've covered in this video and in past videos, none of it can predict an uncertain future. All of it simply helps us assess the probability of good things happening relative to the probability of bad things happening. It's also important to keep in mind that all of this data helps us track what's actually happening in the real world. And we just had a situation where 10% of the stocks in the S&P 500 were above their 200-day moving average. And based on all of the analysis that's being done, they moved from 10% to 70% in a very short period of time. Very similar to this point here and this point here. And in the first case, really good things happen for a long period of time. And in the second case, really good things happen for a long period of time. And as always, the historical cases have absolutely, positively zero impact on what we've done relative to the past few weeks and what we'll do over the next few weeks. The facts that we have in front of us today align with favorable probabilities. The historical analysis helps us understand the facts that we have in front of us today and enables us to think in probabilities. If the facts change, then we will reassess the probabilities. We'll continue to take it day by day with a flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.